for more on how China's imbalances are affecting the rest of the world. We are with Roubini Global Economics analyst Rachel Ziemba. Rachel, thank you very much for joining us on The Pulse. Let's begin, if we can, by putting this in context.
Sure.
What impact do China's trade imbalances have on the rest of the world? Why is it important to all of us?
Sure. Well, I think we can even see from today's trade data how imbalanced China's economy and, in a sense, its trade balances are. China actually imports a lot from the rest of Asia, a lot of components, a lot of items that then go into the items they export to Japan and to the U.S. and to Europe. But I think the other thing the data really shows us is exchange rates matter a lot. In September, the most recent data we have, exports to the EU were back up. I don't think it's a coincidence that it's in the same month that the euro strengthened against the dollar and against the renminbi. And so put that with the fact that China's reserves surged last quarter, and I think we have continued to have a convincing story that China, like many other economies, is intervening heavily to avoid exchange rate appreciation. And we're in an environment now where the global economy has exited the recession, but every country is in a search for market share. And as we have these currency tensions and trade tensions, there's a risk that that weakens global growth ahead, rather than supporting the policies that would increase global demand by supporting consumption within China.
What is the best way to try and convince China to stop manipulating the markets, as it were? It would appear that sometimes when U.S. senators speak, it can actually be counterproductive. Is there a better approach?
Sure, and I actually think this is something that the administration has been trying, in the U.S. has been trying to balance for quite some time, and past administrations as well. Because in a sense, if U.S. officials stand up and say, oh, well, you should do that, you should do the other, the U.S. doesn't like it when countries stand up and say, oh, the U.S. should do this. So I think it's more about finding the areas where there's collaborative, options. And so it's about, in the long term, it's in China's interest, as well as in the U.S., in the U.K., global interest, to have more consumption coming from China.
Can you explain the argument as to why it's actually beneficial for China to allow the yuan to trade more freely?
Sure. Well, so there are two issues. There's a carrot and there's a stick. The carrot is that allowing Chinese consumers to have more purchasing power helps support the long-term goals of consumption. The stick is that by intervening in the markets, they continue to build up U.S. dollar assets, others as well, but most of that increase is really in U.S. And the U.S. dollar over the long term is likely to depreciate. If we think about demographics, if we think about potential growth rates, China, other emerging markets are going to be outpacing advanced economies, and their currencies should increase along with productivity and economic growth. So in the long term, some of China's U.S. dollar hoard is going to be worth less than it is today.
Right. Now, there is also the argument that sometimes America does see the strengthening of the yuan as a kind of universal panacea for all its ills. That really wouldn't be the case either, would it?
I don't think it would. I mean, and I think you mentioned right before the segment that we have to remember that the U.S. consumers import a lot of goods from China. And so the fact that the renminbi is undervalued, Chinese labor costs are low, can help a lot of American consumers who are struggling with 10% unemployment. And so in a sense, a one-off large appreciation of the renminbi also means an increase in import costs for the U.S. So what I think what the issue is here is that the renminbi, the intervention in the markets, is impeding other adjustment in China and elsewhere in the world.
Rachel Ziemba, thank you very much indeed for joining us with your insights today. Thank you.
Thank you for having me.